Good morning, children. Welcome to Betkeru's class, the part 2 of money and credit. So in the previous in the previous class, we studied about the points like barter system, then banking system, double coincidence of bonds, functions of RBI, all that, and deposits and how the bank gets its income. All those things we have discussed. I hope it is clear for you, and if you have any questions, please post it in the comment box and I will clear your doubts. And also we have online classes from 6 to 7 on alternative days. Those who are out of Mysore can attend that. You can contact me on my phone number and attend the classes. And those who are in Mysore, I am put up in Mysore. So those who are in Mysore, you can contact me on the phone and come directly for the classes. Okay, now we shall move on to the next. Yesterday, I did tell you about withdrawal of money. When we deposit our money in the bank, we won't deposit and forget it that our money is safe. We deposit the money to use it whenever we are in need of money. So whenever we are in need of money, we go to the bank and there will be a book given by the bank. Say, this is called a passbook, where there will be all the details of our name, account number and kind of account, and then every page will have the details of our transaction. This is given by the bank, a passbook, to the account holder, and they also give us a check. This is called a checkbook, and each page in the check is called a check leaf. Understand? And when we have to withdraw money, we will make use of this check. There are two kinds of checks. One is called a self-check and another one is called an account payee check. There is a difference between these. And along with that, there is one more called demand draft. I will explain those one by one. Now, what is a self-check? Self-check is one, we can give it to anybody, or there is a line called pay to self. You can write pay to self, write the amount in words and in numbers and sign here and send it with anybody. The bank will give you the money. They will always maintain a minimum balance in the bank, because whenever the depositor goes there, they should pay the money. So they will keep a minimum balance in the bank. Even though they provide credit. Credit is nothing but the loan. That is, in the ordinary language we use it as loan, but in the banking system it is called credit. Then say this is a check leaf. So self-check is one, anybody can withdraw the money. That is, to whomever we give the check, we can get the money. Self-check is that. Or you yourself can go and withdraw the money. There is one more called account payee check. Account payee check is nothing but the transaction of money takes place through the bank. So here the person who has to pay and the person who has to get money, who has to be paid. For example, a person A has to pay certain amount to B. Say, person A has to pay certain amount to B. So now, person A will give a account payee check. The account payee check is one where the person to whom the A has given the check to B in the name of B. Pay to person B, and amount and all the other, and it is also called as crossed check. At the top end he will write account payee, and this person, that is B, has to go to his bank. That is, A must be having his account in the bank number 1, and B must be having in account in the bank number 2. Now, the money transaction should take place between these two banks. So, the person B who gets the account pay check from person A will take the check and go to his bank and deposit it. When he goes to the bank, they give him a challan where he has to fill in all the details along with the check and submit it to the bank. And the bank will contact the bank 1, and the transaction of money takes place through the bank itself. Usually when they have to pay for the LIC life insurance or other companies, they usually provide account payee check. Next, I told you about demand draft, isn't it? Demand draft is that there is a difference between all these kind of payments. Demand draft is one where the person who has to pay will go to his bank and ask them to give him a check for certain companies, usually educational institutions and companies. They demand for DD, that is demand draft. So that is a receipt given by it's like an assurance given by the bank that complete payment will be made. So the person who gets this demand draft can take the money or collect the money by again depositing it in his bank. So that is account pay check and demand draft are different, but the transaction will take place through the bank itself. There is no need for the person to handle cash. Okay. Then, but these methods have now become old methods again. All these were followed till recently, till there was a revolution in the IT field. I told you about NEFT and RTGS, isn't it? NEFT is nothing but National Electronic Fund Transfer. Understand? Where the money is given to the or paid to the other bank immediately through electronic method. And we have RTGS, Real Time Gross Settlement. All both these were the modern methods or electronic methods of transferring cash or money. Then, but now because we are doing all these through the phone, that is phone pay or Google Pay, with those methods again, these have become old, but for large amount we still use these NEFT and RTGS. Then next we shall come to types of credit. Credit is nothing but in the ordinary language we call it loans, but in the banking language it is called credit. Now say types of credit. How do people take credit? There are varieties of credit. Say for example, but there is one which is called formal and informal sector. I have written here, but we shall go to that. That will be the last part of the chapter. So before that we shall study this types of credit. Here, say during festivals, a ready-made garment factory owner will get orders from some companies or some shopkeeper that he needs certain garments during the festival, some special garments, and there will be demand for that kind of garment, so that kind of clothes. So the garment producer will have to supply, because he is committed now. So to supply the goods, the finished goods, he needs variety of things like thread, buttons, lace, all those, and even sewing machines. And he should also have workers, extra workers. For all these things, he has to invest money. So what he does is, he brings all these raw materials from the suppliers and telling them that he will repay the money or pay the money once he gets his money from the person who has demanded for the goods or for the garments. Then he will supply the demand or supply the things, and then he gets back the payment. He will clear all his credits. So this is where the credit has played a positive role. The ready-made garment owner gets high income, so he invests again. So he expands his business. That is where the credit plays a positive role. But there is one children where the credit plays a negative role. You must have read in the newspapers where the farmers take up suicide or they attempt for suicide just because they were unable to repay the loans. So here, why it happens like that? Usually the small landholders or small farmers take loans to invest on their lands, to buy fertilizers, seeds, and other things, the tools, whatever they need. So for all that, they take loans from the banks or sometimes even from a private money lender. And there may be a attack of pest for the crops, and they have to invest on pesticides. And even with all that, there may be failure of crops. Now, how will the farmer repay his loan? Isn't it? So that is where the credit plays a negative role. The farmer will not be able to repay his loan. And of course, the government pays some compensation. They try to help the farmers, but many a times the help may not reach the farmer. Every corner of the country it may happen, but there are certain methods that can be saved from these things, but it's difficult. So the credit plays a positive role and a negative role also. And there is I told you the variety of credits. There is one more type of credit where people take money from the bank and invest it on their business, then pay it part by part. And there are now the banks are providing variety of loans like car loans, housing loans. There are even sometimes the people take loans even to buy buffaloes, cows. All these things are there. Now, when the bank or a person takes a credit, a person takes a credit from the bank, there are certain terms that the borrower has to follow. They are said to be the terms of credit. They are said to be terms of credit. What are the terms of credit? The terms of credit include one, the first and most important thing is collateral. Collateral is nothing but the asset what the borrower has. and that will assure the bank that the borrower will be able to repay the loan. That is one, collateral. And mode of repayment. Say some of the salaried people take loans to construct houses and they repay it through their salaries. A part of their salary is taken by the bank every month from the bank where their salary is credited. So that is one. Okay, terms of credit include collateral, mode of repayment, and another one is the interest rate. Understand? So interest rate will be different for different loans. Now we have educational loans also, educational loan, car loans, housing loans, all that. So these are the terms of credit. Next, children, it is the credits we have other thing like formal sector and informal sector loans. We shall discuss it in the next part about the formal sector and the informal sector loans. And I again request you, if you have any questions, please post it in the comment box. Share, like and subscribe the channel. Thank you, children. Okay, children, I was telling you about the terms of credit, isn't it? Terms of credit include interest rate, that is the interest that is levied on the credit that has been taken, and collateral. Collateral, as I said, it's nothing but the asset the borrower has, and the bank is assured that the borrower is capable of repaying the loan, an assurance of ability of the borrower. Next, we have documentation. In the informal sector, that is when you have to take credit or loan from the bank, there are many documents which we have to submit to the bank. Those are called as documentation. Then next we have mode of repayment. That is how we can repay the loan. So these are the 4 terms of credit. They all are called as terms of credit. Then we shall now come to formal and informal sector loans. What is formal and informal sector? Formal sector loan is the loan provided by the banks. Informal sector loan is the loan that is provided by the private sector, or it is called as the private money lender. Okay, and say okay, we shall come to the end of that, the end of the chapter. Formal sector is through the bank. When we study the graphs given in your textbook, we see that most of the poor households in rural areas and even in the urban areas tend to go for informal sector loans, where the interest rate is very high. And what difference does it make is, if the interest rate is high, the borrower will have to, his cost of production increases and he has to pay more amount for the credit what he has taken. And money lender will have his own method of taking back the money. We know that, we have read about those things. And but why people go to informal sector loan? Because he won't ask for documentation. Usually the money lender will know the borrower personally, so they will have that. And but the well-to-do people or the better households in rural and urban areas and the salaried people tend to take loans from the formal sector, that is from the bank, where the interest rate is comparatively less, so that decreases their cost of production, and even mode of payment will be easier than this, but it includes documentation, which is one of the difficult part, and sometimes the landless laborers, daily wage workers, or even small traders may not have a collateral. So that's one of the problem why these people tend to go for the informal sector. So to avoid this, the government and the banks have taken certain steps. In the beginning I told you micro loans. Micro loans are nothing but the small credit facility provided by the bank for these small traders and small businessmen, and even the landless laborers or small farmers. All these people, they are helped by the bank with these things. So that is why they say the banks and the cooperative societies should increase their loan facility or micro loans, because micro loans also play a vital role in the economy. So here, now I didn't tell you about cooperative societies. We shall come to that now. I told you there are varieties of credits. Say everybody, I told you these small workers and landless laborers or small farmers, they may find it difficult for documentation. But sometimes what they have one more method where they have cooperative societies. What are these cooperative societies? See, usually the people who are involved in the production of same product, for example, weavers cooperative society, cotton merchants cooperative society, sugarcane growers cooperative societies. These are the cooperative societies where the producers themselves pool their savings, a part of their savings, and use it as a fund to provide loans to their members, and the interest rate may be comparatively less than, even sometimes less than the banks, and even sometimes less than the private money lender. So that also helps the people with certain money. In the manufacturing industries, we studied about sugar industries. Most of the sugar industries are run by the cooperative societies, because sugar industry is a seasonal industry. So usually the producers themselves come together and run the sugar factory. Usually that is how the cooperative societies work. Along with that, there is one more method where the government tries to help the low income groups. That is called SHG. This is nothing but self-help group. Self-help group. This is especially to help the women from the disorganized sector of the economy, where, say, this is the group of people who live in the neighborhood will come together. Usually one self-help group will have 15 to 20 members. They may be involved in various work, but they can save their part of income. It may be 25 rupees or 50 rupees, whatever is their ability, they save that money, and when this money becomes a reasonable amount, this can be used as a money to open an account in the bank in the name of the group. Understand? It is self-help group. In the name of the group, an account is open, and sometimes this fund itself is used as a collateral to take loans from the bank for the members. And the bank also provides loans to these self-help groups because the responsibility of repaying the loans will be taken by the group. And if any member fails to pay, or in case of non-repayment of the loans, the group will make the borrower repay it by helping him in one or the other way. This usually for the tailors to buy sewing machines, threads, the other raw materials, whatever they require, and small farmers, even sometimes the landless laborers, and even sometimes the people who work in the houses, the housemaids. They all make themselves into a, come together into a self-help group and help each other. So, cooperative societies, self-help group are the one which help these people from the disorganized sector not to fall into the loan trap. Understand? So they don't need to fall into the hands of the private money lenders who make them pay high interest or provide money for high interest. So this is how the government or the banks try to help these people. So in the next part, we shall summarize all these things and put an end to this chapter, children. Thank you.